Hi, Matt McAleer, Director of Equity Strategies. It is July 22nd, just after the close. I'm here with Shaun Burgess. You know Shaun, portfolio manager and trader on the fixed income desk, primarily in municipal bonds. So Shaun is going to share a few thoughts, a few ideas of what he saw this week. We'll jump over and start with equities first. What we saw this week, a little more repair, right? We've been talking about that for about 3 weeks now, 4 weeks. We had that June 16th real nasty drawdown. Since then, market trying to repair itself. One thing that has stood out on its own a little bit is growth has taken the handle versus value over the last couple of weeks. We've been talking about for some time that value has been where you wanted to be parked in equities. Doesn't mean you're making money in value.
No, but you weren't losing as much as you were in growth.
Right, relative strength,
Sure.
right? It was relatively stronger than growth. That has started to shift. That can just be a spike back. We'll see what the market shares with us next week. Last week, we shared some names that we started to build a watch list. Those names performed well this week. Keep an eye on some of those small and mid-cap names that had gotten down to levels from a price to earnings standpoint as well as a technical standpoint that they were discounting an awful lot of recessionary fear. You know, we're fairly, I shouldn't say certain, we have a feel that by the strict definition of a recession, we'll probably see one, right? 2 consecutive quarters of negative growth. We probably will. It seems like the market and commentaries are really gearing on a severe recession. We don't know that.
Yeah.
So
Yet to be seen.
different sectors, different industries have discounted themselves into an area that they are prepared for a severe recession. If it's mild or if it doesn't come, there's very reasonable valuations. So we'll stay balanced. We'll keep looking for entry points. Keep in mind we have a solid cash position across our equity strategies. Shaun, first thing that caught my eye this week was the Treasury market and the 10-year Treasury. We can talk about the 30-year as well, but the 10-year hitting 280 and the 30-year cracked down below 3.
Yeah.
Moose was on last week talking about the fact that it was only 3-4 weeks ago that the 10-year was at 340.
Yeah. You know, when you talk about recession, the 10 years is a great example of, you know, obviously the bond market's telling you there's some fear out there, and that drive into the 10 to 30 year is really reflecting that. So your bond market's telling you, you know, sending a pretty clear message that, you know, fear of recession is really in investors' minds. And we saw that today. And we saw it this week with the 10 year going from almost 3 down to 275 it hit, actually. Today.
275 today.
275.
Yeah. You know, what's funny is that the interest rate markets are the heartbeat of the fears of inflation versus recession, right?
Yep.
You
Markets
know,
always try to front run. And
week,
see that
week to week,
on
we're
fixed income
seeing
markets.
rates either afraid of inflation and making that run higher, or afraid of a recession and making that drop. Real battle in interest rate land. What about in terms of municipal bonds and how those rates reacted to the drop in Treasury rates?
You know, a very quiet week on the municipal front. You typically see that in the summer. You get the summer doldrums setting in. And you didn't see that near the volatile move you saw on the Treasury market in the fixed income or the municipal market. You know, we went down a little bit in yield, a little bit, but not as much as you saw in the Treasury market. So it was definitely a little bit of underperformance in Munis, but it gives you a great opportunity to still buy those 4%, you know, or better yields at ratios to Treasuries that are really, in our view, attractive. And John's talked about it before, how we think the Muni market's really oversold. And, you know, when you see Treasuries come down and Munis stay where they are, you get a great opportunity to lock in a really attractive, you know, long 4% tax-free yield.
I always hear the desk led by John and Patty on our credit side and Amy talking about spreads between Treasuries and Munis. And when you can look at say a 30-year Treasury at a 298 or something today and a 30-year Muni, tax-free, at close or more than a 4, in some instances on a double A. That's very, very attractive. And Shaun brought out his trading hat and said, Munis lagged Treasuries today or this week. Keep in mind, Shaun's talking about in price, not in yield. As a trader, Shaun zeroes in on the price of bonds. Muni yields stayed elevated. And we'll take that as a buyer. We'll take that, giving us a little more time to get cash deployed and try to pull up the overall yield in bond portfolios. Remember, even if current bonds show some weakness in a rising interest rate environment, you want to be buying these yields. Because 2 years ago, the average current yield in a portfolio may have been 160.
Yeah.
And at the end of this year, if we've redeployed into these higher yields, maybe you have the next 5-year run at a 3, at a 2.
That's why we like it.
It's real income. So great. Thanks for joining me, Shaun. Enjoy the weekend. Don't forget to like and subscribe so you can be alerted to any of our videos, and we'll see you next Friday.